Welcome to Swing Trade Pro 2.0, the 5-step swing trading blueprint. I am Frank Ochoa, president and founder of Pivot Boss and author of the book Secrets of a Pivot Boss. In this section, we are going to discuss step 4, execution. And perhaps of all the various steps in Swing Trade Pro 2.0, execution is by far the most important. If you're going to be able to enter a trade or exit a trade, you must know how you want to execute. And again, you have to practice flawless execution because execution error is perhaps the most costly of all trading errors. So we are going to discuss how to enter a trade, how to exit a trade using various entry and exit techniques. And without further ado, let's go ahead and get started with step 4, execution. While each step in our 5-step blueprint is important, perhaps no other step requires more attention to detail, focus, and practice than step 4, execution. Your goal is to be able to execute your bias in the market without error, as execution error is generally the most costly of all trading errors. Practice flawless execution of your strategies for each and every trade. In this step, you will learn how to scale into positions according to the level of exposure that you're willing to take at the outset of a trade. Scaling into trades is the process of building a position by first testing the trade with smaller size and then adding more exposure as the position begins to work in your favor. This approach is quite effective as traders have the ability to reward winning trades with additional exposure while limiting losing trades to smaller losses due to smaller starting size. You will learn 2 entry techniques that will give you the ability to scale into positions, thereby giving you an additional lever to adjust in terms of risk management alongside trade allocation, which we discussed in sections 1. Now again, you will also learn 3 techniques for scaling out of positions as a powerful form of trade management. Scaling out of trades is the process of gradually taking profits as a position moves in your favor, or reducing exposure should a position move against you. These techniques are designed to provide consistency, reduce risk exposure, and offer flexibility while in trade. Your goal is to be able to execute entries and exits in any market by using and combining the following entry and scaling techniques. So number 1, what we're looking at right here is basically a nice set of techniques that will give us everything we need to do to enter and exit a position. So techniques for scaling into positions, we're going to use the 1x3 entry technique and the 1x2 entry technique. So basically you're entering in thirds or entering in halves. And by doing that, again, you are testing smaller size on that entry, and should that position take a loss, you're also going to basically lose less money because of the smaller starting size. Over here, these are the techniques for scaling out of positions that we will generally use. The 11 scaling technique, that's scaling out in halves. The 111 technique, which is scaling out in thirds. And the 211 technique, which is scaling out at half at first and then quarters on the back end. So again, these are the various techniques that we will be using in Swing Trade Pro 2.0. And your goal, again, is to be able to flawlessly and seamlessly execute each of these types of techniques and combine them for the opportunities that you need. Sometimes you may enter by halves. So you may enter right away half of your allowable trade allocation, and then later on, if the trade warrants such, you can add another half to it. And then after you had half and half, you may want to scale out half and half, or scale out in thirds, or perhaps scale out in additional ways. So again, being able to move in and out of these entry and exit techniques and combine them where you need to is going to be the key here. So again, we're going to go ahead and cover these starting right now. We are going to start off with the 1x3 entry technique. A 3-part entry technique is the 1x3 entry technique. This is basically being able to scale into a position by thirds. So the 1x3 entry technique is a 3-part technique used for scaling into position by thirds. Each scale basically splits the maximum allowable trade allocation by a third and can have multiple contracts or shares per scale in. Let's take a look here. Here's what the 1x3 technique looks like. The first entry right here enters with 33% of trade allocation, your maximum trade allocation. Execute a starting position by scaling into a third of your maximum allowable trade allocation. The second entry, you would look to add an additional third more exposure should price move in your favor or if you want to defend your trade. And lastly, if it warrants such, you would scale into a final 33% of allowable exposure should price move in your favor or if you want to defend that trade. So you're basically entering your trade in thirds. An additional option, a 1x3 technique variation, is to execute 50% of allowable trade allocation on the first entry and then adding 25% additional exposure on both the second and third legs. So there's two different ways here. Basically, the 1x3 says you're just entering in 3 different allocations. But again, here's a variation right here where you can basically enter 50% up front and then add a quarter of exposure on the next 2 legs. But either way, you're entering in 3 different chunks. So let's take a look here at an example. Say you have a core equity of $100,000 and you want to use a 1.5% trade allocation. 1.5 trade allocation would be a moderate approach for how I typically enter a market. Remember, we have the 1%, the 1.5%, and the 2.6% trade allocations, right? This is my conservative, this is my moderate, and this is my aggressive. And usually I stick somewhere around here in most markets, but if it's a great high odds opportunity, I'll go aggressive. If it's a good opportunity or maybe it's quieter volatility, maybe I'll go conservative. But any one of these allocations can be used with a 1x3 technique. Whatever is your maximum allowable trade allocation, split it in 3, and that is now your maximum allocation for each scale in. So right here, core equity, 100K, you have 1.5% trade allocation, which comes out to $1,500. Your first entry would be $500 worth of risk. Your second entry would be an additional $500 worth of risk, and your third entry would be a final $500 worth of risk, giving you a total of $1,500 that you are risking for that trade. Now, again, this can be used with options, it can be used by with futures, it can be used trading stocks. However you want to do this, you can always use it with any approach that you want to do with any underlying on any account size. So again, I really like this technique for scaling into trades. And typically speaking, again, you can scale in any number of times you want, right? There are times where I go 100% of trade allocation right away. That's 100% entry. Other times I'm looking at the 33% entry, which is the 1x3. And other times I'm looking at the 50% entry, which is the 1x2, which we'll discuss soon. But again, you can scale in 5 times if you want to. You can scale in 10 times if you want to. I think that's a little unnecessary overall. I mean, you could go 4 times or 5 times, whatever the case is. But for the most part, I like having 3 options. You're either going in full size, you're going in half size, or you're going in a third. And then if the trade warrants such, you will then add that additional exposure. Let's go ahead and look at the next one here. This slide shows a 1x3 entry technique in GPOR. So the 1x3 entry technique allows traders to build a position in 3 parts. First, by testing the trade with smaller size, 33% of trade allocation, and then adding more exposure if necessary, the last 66% in 2 different scales. This approach allows traders to reward winning trades with additional exposure while limiting the losses due to smaller starting size. That's awesome. Remember, if we have $1,500 here and we're going to go 3 different scales, 1, 2, 3, each $500, if you enter with the first scale here at $500 and the trade goes down against you, you're only going to lose the 500. You're not going to lose the total 1,500, right? So you're only losing a third of your maximum allowable trade allocation. And again, that is a much better way to go than going 100% entry and then getting stopped out on 100% of your trade allocation. And as a matter of fact, studies have shown that scaling into trades over the long haul actually plays out much better in your favor than scaling out of trades as a general comparison between the two. But doing a combination of the two, using them both, being able to scale in and scale out, I think gives you the best of both worlds. Again, there are times where I'll go in 100% entry, but I have to be very, very confident, and it has to be a high probability opportunity. If not, then I will scale in some form. So let's take a look at this example. Right here we have a great rejection day trade sequence. You have a huge rejection day here with an automated signal. You see the midpoint is right there. This is the top of the the top of the absorption zone, and so you have this absorption zone right here. And typically speaking, there's many ways to engage this zone, right? You have your major rejection day here, and so typically speaking, if I am very bullish this opportunity, I'll enter at the end of the day here. So in the last hour of the day, you want to start an initial position by executing an entry with 33% of trade allocation during the last hour of a rejection day. There you go. On the second day, if price pulls back to the absorption zone, you want to add 33%. So that's the second entry. Add to the position by executing an entry at or near the absorption zone on day 2 with 33% trade allocation. Boom, now you're in at the absorption zone and from the last hour of the rejection day. So now you're in 66% from here and here of maximum allowable trade allocation. Now, the next third can come usually for me upon a failed new low. So if price pushes through the absorption day low, that's when I'll likely add that last third. And so here it is right here. Price pushes down below the midpoint, but by the end of the day had already pushed back above, closed back above the prior session's lows, 2-day lows, and back above the absorption zone. So again, being able to enter anywhere in here, anywhere in there, right? It could be right back at the midpoint. It could be upon actually seeing the rejection of 2-day lows. It could be in the last hour of the day, right? But you're adding exposure on this day after the pullback. And again, 1/3 here, 1/3 there, 1/3 there, and now you're in a full 100% trade. So you reserve the last 33% of trade allocation to defend your position should a failed new low develop on days 3 and or day 4. And then now once you're in and you have 1, 2, 3, 4 days of absorption and development, you're looking for a stop run day or a continuation leg, and bang, this one does it. A major move up, a huge move that takes you all the way back toward recent highs. And again, after building a position here, building a position here, building a position here, you want to be able to take profits, at least partially, on the first major move in your direction. So after building a successful position during the first 4 days of rejection and absorption, look to pay yourself on the first major pop in your favor, taking either full or partial profits. So again, this is a great way to enter a trade using our rejection trade sequences that we've studied already in section 2. Major rejection day, great absorption zone, nice absorption day here, you have another absorption day there, you have a failed new low here, and a stop run / continuation day here, exactly as you would draw it up, and it gave you various opportunities to build a position. And again, on the first major pop, you want to go ahead and take those profits. Let's take a look at our second entry technique, which is the 1x2 entry technique. The 1x2 entry technique is a 2-part technique used for scaling into a position by halves. Each scale-in splits the maximum allowable trade allocation by 1/2 and can have multiple contracts or shares per scale-in. So here's the 1x2 and what it looks like. Basically, the first entry uses 50% of trade allocation. You execute a starting position by scaling into half of your maximum allowable trade allocation. And then you look to add the final 50% of allowable exposure should price move in your favor, or if you want to defend your trade. So again, half and half. So this is what it looks like with an example. The same 100K, the same 1.5% trade allocation, so the same $1,500 max allowable trade allocation for that opportunity. But for the first entry, we're going to use half of it and go 750 of allowable trade allocation. On the second entry, we will add the last 750 of trade allocation for a total risk of 1,500 bucks. So 750 by 2. And again, very, very simple concept. Let's take a look at an example. So again, we have the same example here in GPOR, but different entry opportunities. So number one, again, you can enter here at the end of the day, but say you're a little bit more cautious and you want to see price pull back so it gives you a better opportunity to get a cheaper fill. So you wait, and the next day price opens above the rejection day midpoint and starts to drop into that section, right? That is when you would want to start an initial position by executing an entry with 50% of trade allocation at or near the absorption zone. So whenever price pulls back that morning, you want it somewhere in here, and now you're able to pick up that price at a much cheaper zone, right? Because at first it was here, it opens the next day and drops, you get it a little cheaper, and now you're in. On the second leg, again, I usually like to look for a failed new low to defend the trade. So right here, you would reserve the last 50% of trade allocation to defend your position should a failed new low develop. Those are just two of the areas where this could have been done, right? You also could have entered here 50% at the end of the day, and you could have added 50% there. You could have added 50% here to begin the trade and added the last 50 here, right? So there's various ways that you can execute this type of entry, and it all depends on what's happening and the scenario at hand. It depends on the odds of profitability for that potential opportunity. And again, sometimes when there's a significant rejection day, I like to be in at least partially at the end of the day, because sometimes this type of continuation can happen and at least you have some exposure there to the market. But again, you have flexibility and you have various entry points. Entry point 1, entry point 2, entry point 3, and then your stop run day, that could be entry point 4 if you really wanted. So if you got in to 50% of the trade here or here or here, you could add 50% on this day on the stop run day as well. So various combinations where you could enter this trade with your 50% trade allocation. So the 1x2 entry technique allows traders to conservatively scale into a position using 50% of allowable trade allocation. Winners get rewarded with additional exposure, and trades that underperform do so on smaller size. That is a big benefit of using this type of scaling technique, because again, for some of you that are struggling with consistency, or some of you that are still struggling with trade location, this type of benefit here by getting in small at the very beginning, and if you experience an adverse move against you or you experience a stop loss, you're going to be doing it on much smaller size. So again, a very beneficial way for you to execute entries into a market. So here is a look at Alibaba. Alibaba is a great moving chart. A lot of great movement within this trading range, and there was a lot of great opportunities here, both up and down. Right here, let's take a look at the first one. For example, all of these various opportunities have an approach where you can enter these markets. So we want to choose an entry technique that aligns with the probability of profit for a given opportunity. For example, use the 1x2 or 1x3 entry technique for counter trend trades, while entering high odds trades more aggressively. So Alibaba has been trending higher overall for a long time as of the point of this chart. And at that point, these were primary trend trades. Those were primary trend trades. These were counter trend trades, right? These were counter trend moves. So the idea of choosing an entry technique that aligns with the probability of profit for a given opportunity is very, very important, which means if a market is trending up, you want to be more aggressive on the pullbacks in the direction of the trend, but you want to be more cautious on the counter trend moves because they are counter trend. So if you could look right here, this is our 1x3 entry. So number one, first scale in, execute 33% of trade allocation during the last hour of the rejection day. That would be here. Number two, third scale in, second scale in, right? All this, the second scale in, execute 33% somewhere on these absorption days at or near the rejection point of the midpoint, right? That right there can be done on day 2 or day 3, so any of those days. So you get a significant rejection day. Here's our automated signal. We can get in a third here at the end of this day. You can get a third somewhere on these absorption days, and if you have a failed new low, you can then add additional exposure on that failed new low, right? And now you're allocated 3 ways ahead of a big pop-up. This looks almost like that GPOR trade, right? It's very, very similar, but again, that is the rejection day trade sequence which we studied in step 2 of our Swing Trade Pro 2.0 series. So again, right here, a great way to look for rejection, identify a great absorption zone, and then you have several days where you can then do business, execute your entries, build a position, and then as soon as this thing pops in your favor, you're taking some profits here, you're taking some profits on all of these highs as this thing goes toward your target zone. Here's the second one. This is a counter trend trade, right? A counter trend trade. And what happened here was we had a new high, and then this was a failed new high, and then boom, price gaps way down, rallies back up, and then closes back down, leaving behind another major rejection day. So all we're doing here is just trading the days with the signals. This has a signal. It's a great rejection day. Let's get in. This is a sell rejection day signal. Let's look at getting into this one. So in this case, again, a very bearish day. You can scale into half of your trade allocation in the last hour of that day. And if price pulls back to the absorption zone, you can add 50% of allowable trade allocation at that time. And again, as price pushes in your favor, you can take some off the table along the way. And so again, a great rejection. Over here, this rejection day right here was significant because it took out recent lows, took out those lows, took out these lows, and it also coincided with a major area of support, the CLVN, which is up to about 165, 166. So it came into a great area of support. In that case, perhaps I don't want to scale in. I want to enter the entire allowable trade allocation on this day. Or I could enter the entire allowable trade allocation on the pullback the next day. So again, you have the option on a rejection day trade sequence to get in at the end of the day, the last hour of the day of the rejection day, a confirmed rejection day. And you also have the ability to look at the second entry point, which is if price opens above the midpoint the next day, any pullback toward that mid allows an opportunity to enter that trade at that point. And now you would be in either at the end of the day here, or you would be in the next morning, and now you're in 100% of that entry, which means, again, if you are risking 1.5% of allowable trade allocation, right, 1.5% of your core equity, then you would enter the entire 100% on this entry for a 100% entry. So you have the 100% entry, which is basically a 1x1. You have your 1x2 entry and your 1x3. 100% here, you got 50% entry here and 33% entry there. Again, I would use a 100% entry at those times when you have significant odds in your favor, or you're leaning up against significant support, those types of things. A significant rejection day where you're very confident, go ahead and enter the entire trade allocation. But on counter trend trades, or maybe when you think that the market is, it has a great opportunity to bounce, but it may not be the home run you're looking for, then perhaps you can build in a position in parts, either 2 or 3 scales. Over here, another great opportunity. And again, for this one, every time is a little different. This one also bounced again off of support a couple of times, rallied significantly here, and this was a great failed new low. That was a great failed new low right there. Price drops down, takes out 1, 2, 3 day lows, and by the end of the day was back above the prior session's midpoint. That is a major rejection, and I want to be in on that. So you have two options again. Because this is a great rejection, one of my bread and butter types of trades, I want to get in at the close of that day, or I want to get in upon a retest of the absorption zone. So again, you can enter a 100% of trade allocation at the end of the day or at the absorption zone or upon a failed new low, whatever the case may be. And again, in this specific instance, I actually went 100% trade allocation in the last hour of this day and held it as it continued higher to close. This one was ahead of earnings, and so that's the reason. Because earnings were the next morning before the market, and so I wanted to be positioned in the last hour before earnings. After earnings were announced, price dropped down first and then rallied significantly. So I still would have had time to add if I really wanted to. But again, you never know if earnings would have led this thing to gap up and I would have missed the boat if I didn't get in. So every situation is a little different. But in this case, I went 100% allocation at the end of the day. But there was also an opportunity to add to that position or enter that position 100% at the absorption zone. So again, various opportunities, various types of trades in here. All we're looking at is rejection tails, rejection tail, rejection tail, and rejection tail with these signals, and then looking at our entry zones, right? Using our rejection day trade sequence. There was also a rejection day here, didn't get a signal only because the size of the day's range wasn't bigger than the average, and all of these are bigger than the average, thus the reason why there's a signal there. But you don't need a signal to trade that, right? This is clearly a rejection at an LVN, at an edge, and there could be an opportunity to get in at the end of the day here or get in on the midpoint, or if price gaps up, get in on the pullback after the gap for a continuation higher. So again, you don't have to have a signal to trade any of these, but again, in this example, I wanted to show the various rejection days and the sequences that developed and how you can scale into those using the 1x2, 1x3, or even the 100% entry technique. Now this is a look at Tesla. Tesla also several rejection days here. You can see a rejection day here with a signal, one over here with a signal, and one up here with a signal, right? So again, all of these are great opportunities. Again, Tesla, another one of those stocks with great trading ranges, great back and forth, great two-way trade, as there's lots of short sellers, there's lots of buyers. And when you have a major rejection day like this here, at an edge where it takes out multiple day lows and then shoots back up, providing a signal, again, there's an opportunity to enter at the end of the day here. And there's also an opportunity to enter at the midpoint of the rejection day or the absorption zone in general. This one hit a perfect midpoint retest right there and then bounced back up. So again, in this case, when you use a 1x2 entry, you can enter half the trade here during the last hour of the rejection day and enter the next half at the midpoint the next morning. And then again, now you're fully positioned 100% to enjoy any potential pop in your favor. When you get a major day up like this, that's when you want to take profits, at least partially. And then you can hold some for a continuation to your next target, wherever it may be. In this case, when we bounced from down here, we were looking for a move into 360, and we got it. But I wouldn't be holding 100% all the way to that zone. You got to pay yourself along the way. And on the big bursts higher, those are the perfect times to pay yourself. Over here, another 1x2 entry. A great rejection day at resistance. Price closes way lower below the previous session's mid. And so again, this gives you an opportunity to enter that trade at the end of the session on day one rejection. And then on day two, if price opens below the previous low, any pullback into the prior close or open offers an opportunity here to defend and get in the trade. So it didn't necessarily go all the way to the absorption zone, but keep in mind, if you have a big long range day like this and price gaps down, you almost don't want it to come all the way back to the mid, because then it might start to climb through it. So in this case, it's okay. It's okay if you don't get all the way back to the absorption zone if price gaps down out of range, because any pullback into range could be an opportunity to add that portion back. So again, two scales, the first one at the end of the day on the rejection day, and the second one on the pullback in the morning on day 2. That gets you allocated ahead of a potential push downward. Over here, another great rejection day, a big high range day. Again, on a significant rejection day, it's not uncommon for me to go ahead and get in some sort of size at the end of the day on that rejection day. And then should price pull back the next morning into the trigger zone, that's where you can add 50% trade allocation at that time. So again, look at how great those midpoint retests are. This is a great perfect retest there, another great one there. This one was shy, but again it gapped down, so again it's the range retest. So great chart here with lots of rejections, great opportunities to enter the trade. And again, anytime you have a significant rejection day, you always have the option to get in at the end of the day, at least some sort of size, so that you are positioned. And then if price were to pull back toward your midpoint of the rejection day or toward that absorption zone, you can add exposure at that time. All right, let's talk about scaling techniques now. Scaling techniques are very important because you have to know how you want to take your trade off the table. How do you want to profit? How do you want to take your trade off the table if it goes against you, right? Sometimes you don't have to necessarily scale to take profits. Sometimes you can scale to loosen up some of the risk in case the position's going against you somewhat. So again, there's various ways here to use scaling techniques. For the most part, we're looking at this in terms of looking at profit objectives. So number one, the 11 scaling technique is a two-part technique used for scaling out of a position by halves. Each scale out can have multiple contracts and shares, but ideally there are the same number of units for each scale out. Over here, the first scale out of half of the position at your first target, T1, and scale out of your second and last portion of your position at target 2, right? The second target. Very simple. And so say right now you have a trade allocation that allows you to trade 20 contracts of something. As soon as price pushes into your favor and you get to a T1 target, you would look to scale half of those contracts, selling 10 at that price. And then as price continues onward to your T2 target, you would then scale out the last half of those contracts, the last 10 at that target. So again, you're just taking half off at one target and half off at the next. What this does is many different things. It helps you to alleviate some of that mental fear about taking profits or when do I take profits, because again, sometimes if price is pushing up, you can start to get greedy about taking or holding that position to kind of get more money, and then inevitably this may happen, and now you were holding on to 100% of that position, and now it's all the way back to your entry, and now you're kicking yourself for not taking something at those highs. So again, that's why I always say, if price pops in your favor after you've built a position, take some off the table. Take a third, take a half, take a fourth, take something, because again, you're paying yourself just like you should. And now by paying yourself, you're booking profits. It gives you some mental clarity. It also gives you an upper hand in the trade. Now, if you've taken some profits, taken half of that trade, you can add that trade back on a pullback to a key level. You can add it back. So it gives you flexibility. It gives you the upper hand in the trade. So there's many different benefits to scaling out of a position. Let's take a look at an example. Here's PRGO. PRGO is a good one here. Use the 11 scaling technique to scale out of a position in 2 equal parts. Look to scale out of 50% of the position on the first favorable move after building a position, and scale out of the last 50% at your forecasted target zone. This technique is designed to provide consistency, reduce risk exposure, and offer flexibility. So this is a look at PRGO. We had a great rejection day here. Solid rejection day. Look at the signal. It took out the previous low and popped all the way back above the midpoint of that session. That's a strong, strong rejection day. And so there's a couple of ways you can enter this, right? You can enter at this zone here in the last hour of the day. You can add to it here. You can enter here if you even wanted to. In my case, I entered that position right there, right at the midpoint. I entered 100% entry at that point. And what we were looking for was for a return to value, which is 74, and then a return to the middle portion of this green range here, which is our high probability target zone forecasted from the recent low. And using this low and forecasting up average monthly range over the last 10 months, you get that zone. And so what I mentioned to our traders in the trading room was I'm looking to enter here, and as soon as price pops in our favor, I will take some off, and as soon as price hits the middle of that high probability target zone, I will take the rest off. And that is exactly what I did. And so in this case, the 11 scaling technique, after building a position within the rejection day sequence, look to take partial profits after the first major pop in your favor, and again after price reaches your forecasted target zone. So the first scale for me came on this day. Price pops up and rallies. I take profits. So I scaled half the position after the first expansion day in my favor. It is important to pay yourself on partial profits after successfully building a position within the rejection sequence in order to reduce risk and improve your mental well-being. So again, you got to take those profits. And even the next day after here, I had made a 100% entry. I mentioned to the traders, hey, we gapped right to it and we're dropping down. But I'm going to let this thing continue to develop. Unless it closes below that midpoint, I am sticking with my guns. And eventually it rallied, it closed higher, and then 2 days later it was giving me a great profit objective. Another day after that, it was right in the zone, and I took the rest up there. So again, scaling half of the position after price enters the forecasted target zone, and that completed the trade. So that was a great trade here. Again, another rejection day trade sequence. A rejection day trade sequence, an absorption day, a failed new low, a breakout and continuation, and this thing hits our target zone. That took all of 1, 2, 3, 4, 5 days. And again, that right there is the epitome of Swing Trade Pro 2.0. It's being able to identify those rejection sequences as they are happening or before they're happening, and then being able to identify and pinpoint what's likely to happen next, build your position, and start paying yourself as it hits your zone. Once it's done, you're out, and look what happened afterwards. Nothing. It just went sideways after that, after reaching that zone. So again, another great trade, and you're able to take profits on those favorable pops higher. Let's take a look now at the 111 scaling technique. So the 111 scaling technique is a 3-part technique used for scaling out of a position by thirds. Each scale out can have multiple contracts or shares, but ideally there are the same number of units for each scale out. So again, instead of scaling out 50% at a time, we're basically going to be doing 33% of the time. So the first scale would be a third of your position at your T1 target. The second scale would be a third at your T2 target, and the third scale would be a third at your T3 target. So it looks something like this. Say you're long 300 shares of some stock or ETF. The first 100 shares would come off at T1, the second 100 shares would come off at T2, and the third 100 shares would come off at T3. And that's very straightforward. Let's take a look at an example. All right, this one right here is TXN. Texas Instruments, this was a fantastic rejection. This occurred right here in the middle of the CLVN, a major CLVN right here at the 107s. You can see the profile bend significantly there. Look at this major drop right here. Huge drop. It hit the level, but by the end of the day had closed back above 2-day lows. There's not a signal there because it's not a classic rejection day in terms of the tail being X amount bigger than the body, but this is clearly a rejection day. And so again, with a big rejection day here, I mentioned that by rejecting these lows, we likely rally back to the top end of the trading range and inside our high probability target zone, somewhere between 115 and 116. And so again, I entered 100% of that trade about right here, right there. And so after this rejection day, price pulled back. It hit the midpoint. It was sitting right at the midpoint. I executed a 100% entry there. And now, as soon as the next day came along, a huge rally occurred. I took 33% of that trade right there at the highs of the day, took a third off. The next day, we got a gap down and it dropped significantly. Now, I didn't add to this zone, but the traders in our room did. They mentioned because some traders didn't get in this type of move right away when it happened. And so I mentioned it's okay if you didn't get in, because if it retests 110 the next day, that could be your entry for a continuation. So again, that was the potential for me to add back. If I scaled 33% here, I could have added that third back when it retested the 110 level. I chose not to and instead hold the last 66% of the trade. And then again, when price popped higher and hit the 115 zone right here, which was the front end of the high probability target zone, I took another third off right at that time. I think it was, by the time I took it off, 114.95, somewhere in there. And then I said, okay, I'm going to hold the rest for 116 and see if we can get there. The next morning, price gaps up, hits 116 and starts to fall a little bit. I take the last bit off right there, the final third, when price was no longer able to hold above the previous session's high, and taking it off right in that zone. So I took a third off here, I took a third off when it hit the green level, and I took a third off after it hit the 116. I made a 100% entry right at that point right there. And the way we traded this one, the way I traded this one, I believe, was the 110-115 call debit spread. So I bought the 110 call, I sold the 115 call, and that gave me a great 5-point spread, and I paid whatever I paid for it, and as it continued higher, I took those profits and left with a great little trade. So again, this is the epitome of a Swing Trade Pro 2.0 swing trade. A great rejection day signature, a great rejection day trade sequence with an absorption day, a stop run day. You had your fade after stop run, you had your retest after stop run, and you had your continuation right into the target. Again, every single thing that you wanted to see out of a trade, this one had it, and it held the major CLVN, which it held for many, many months. So to hold that level again and see a major rejection, a no-brainer to try and get that price to return back toward previous highs. So again, another high probability trade, one of my favorite trades here recently, because again, any trade that works out the way you're looking for is a great trade in my book. And lastly, let's take a look at the 211 scaling technique. The 211 scaling technique is a three-part technique that is used for scaling out of a position by half at first and then by quarters. So each scale out can have multiple contracts and shares, but ideally the first scale is twice the size as the second and third scales. So just to put it cleanly and plainly right here, the first scale, again, you're getting out of half the position at your T1 target, that's 50%. You're scaling out a quarter of the position at your second target, T2, that's 25%. And then you're scaling out the last quarter of your position at a T3 target, again, another 25%. So again, it looks like this. Say you're trading a futures contract and you're in 4 contracts. You want to take 2 off at T1, take another contract off at T2, and take your last contract off at T3. So again, you're scaling by half at first and then scaling by quarters on scales 2 and 3. Let's take a look at an example. So this is GoDaddy, another fantastic chart, another classic STP 2.0 trade. This one had been trending up very, very nicely for the long term. I mentioned every single time this pulls back, it's a buying opportunity. It eventually pulled back and gave us a great rejection day type here. And you can see right there a great rejection day. And it occurs right at market structure. So the 50-51 zone had been resistance, 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 then it took it bid, and when it came back to it, it started to become support. So to see a rejection day develop at that area right here was very positive. And so when that occurs, I'm looking to enter the trade either at the end of the day here or at the midpoint here. In this case, anytime you have a price kind of close farther off the highs like it is here, leaving a little bit of shadow on top, typically speaking, I'll wait for the next morning for a retest entry back at the absorption zone. So in this case, price opens the next day higher above the midpoint and absorption zone and then drops into the absorption zone. That is your entry right there. So that right there constituted another 100% of entry again. So after building a position within the rejection day sequence, look to scale the position in 3 parts, typically by scaling 50% at first and then twice more in 25% scales. So again, as I usually mention, you want to take profits on your first major favorable pop in your favor. This thing bounces off the entry point and rallies and has a huge day up on day 2, actually day 3 after your entry. Entry, day 2, day 3. This is a great spot to take half the trade. Why half? Well, it reached our target zone. It reached the target zone. So if this is the low, on average, this is your target. So taking half off there makes a big, it makes sense. Additionally, you want to perhaps loosen up or alleviate some of that risk capital because you do have earnings coming out in a few days. And that was what was so great about this idea. You can get long ahead of earnings and then buy the rumor, sell the news, or if earnings kills it, then you're making even more money. And so again, the goal is to buy this heading into earnings. You take half off at the target zone. Again, another big pop-up to this high, and that's another great time to take off the second scale, and that's a quarter of your position. And then at that point now, 75% of your trade is profit. You've already out of that trade and you're now holding just a final 25% ahead of earnings. And that's a good way to go. You want to be able to get it down here at a good value, bring it up, scale to reduce risk exposure, and then you have now one final 0.25% of that trade, or not 0.25%, 25% of that trade ahead of earnings, just in case you see a major pop. This thing gaps up through significant resistance, which is also a CLVN, and rallies big. And again, that's the point right there where you can take off the final 25% of that trade. Again, another classic STP 2.0 trade. Just a great rejection day trade sequence, a great midpoint entry, great continuation to the target zone, and then a burst into earnings. Another fantastic trade. Well, that does it for our Step 4 execution portion of our Swing Trade Pro 2.0 series. Execution, as I mentioned, is one of the most important aspects of Swing Trade Pro 2.0 because you must practice flawless execution in order to execute your ideas and also to avoid execution errors because those, again, can be the most costly of all trading errors. Again, it's always my favorite here to execute entries and scale either into them or out of them, because again, it's doing something mentally for you. It's helping you alleviate that mental capital, improves your well-being, allows you to pay yourself as price moves in your favor. And if you're scaling into trades and happen to miss out on a great entry and price goes against you, again, you're going to typically be losing money on a smaller percentage of your allowable trade allocation, and over the long term, that makes a big difference to your bottom line.